Well, good afternoon, everyone, and thank you so much for joining myself, Kate Clarke, and Michael Anthony. By way of background, for those of you who are new to these webinars, we started doing them last year, mainly focused on scaling SME business owners. This one is specifically for those thinking about going into e-commerce. If you're already an established e-commerce business, then we're probably not going to tell you anything that you don't already know. But this is very much someone who is thinking about setting up an e-commerce business. My background, I'm a chartered accountant by trade, qualified in accountancy practice, and then 10 years ago, turned to the dark side and set up Artemis Clarke. And we specialize in placing senior finance professionals into scaling businesses. So these webinars are designed for our target audience and hopefully will add some value. So, and I'm delighted to be joined by Michael Anthony today, who has been, I think, a finance director for 12 years now, and very much specializes in the e-commerce space. So I thought that inviting him along today to talk about all he knows about e-commerce would be super valuable for any businesses looking to sort of go into that space. So Michael, if you want to just give a bit of a background about yourself, that would be super useful, please.
Sure. Okay. Well, firstly, thank you very much for having me on. I'm a fellow of the Institute of Chartered Accountants, and I've been involved in e-commerce mainly for the last 6 years. It started out actually with a small teddy bear company where we imported from China, sold for both our own website and for Amazon. And from there, through one venture or another, I've been involved in a 40 million turnover gardening and Christmas decoration company, again, mainly importing from China and selling mainly on their website, not really through Amazon. I've been involved with the purchase of eBuyer. I was involved with that for 1 year. That's a £250 million electronics company, which sells virtually entirely through their own website. And currently, I'm the FD of a £14 million e-commerce business that sells pharmaceuticals nearly entirely through Amazon itself. Maybe a little bit through TikTok, but so it's a wide range, really. It's mainly sort of like small, medium, and large private companies.
Yeah, no, fantastic. And you obviously mentioned Amazon there, so you've got vast experience of dealing with Amazon.
Yeah.
If you're starting out as an e-commerce business, how do you know if Amazon is the right platform for you?
Okay, the very quick answer to that is margins. If you've got tight margins, in my opinion, Amazon doesn't work for you. And I'll give you one example. So let's say we've got Joe Blogs and he sells 5 kilogram, 100-pound chocolate bars. Now, if you're selling for Amazon, there's 2 ways to sell for Amazon. One is 1p, and that's basically you wholesale the whole lot to Amazon. So you are selling directly to Amazon, it's wholesale. They'll buy vast quantities, large quantities to Amazon. The other way to sell to Amazon is 3p, where you set up your own area and you actually use Amazon just as a marketplace. So when I say selling for Amazon, that is very, very simplistic for the whole of Amazon. So let's just take the first example. We sell directly to Amazon. Now, if you've £100, now Amazon won't want to buy them for £100 because they're Amazon, they're huge. They might want to buy them for £80. So you've got to give a discount, a bulk discount, as you would do with a wholesaler. Then on top of that, Amazon may deduct, let's say, 5.5% marketing fees. So Amazon will charge you for the marketing fees to sell basically your product on their site. Then there's the damage and returns allowance of maybe another 5%. And then there's the Amazon fulfillment fee, which is basically the delivery fee, including packaging. And because let's just say it's a 5 kilogram bar, that could be £10. So where you're selling £100 to a normal person in the street, via Amazon, you will only be getting £60 net. So that's where you go.
Now, after they've taken all the costs. Yeah.
Exactly. So if it costs you £70 to actually make it, it doesn't work selling through Amazon.
It doesn't work, yeah.
Yeah. As I say, this is a very generic example, but I just wanted to give you an idea of why I say in first instance. And it also gives you an example of going back from the companies I mentioned, eBuyer. eBuyer sells for its own website because they sell hardware computer equipment. Hardware computer equipment has low margins. There are a few items that you might be able to sell on Amazon, but that's a very tiny part of their business. For the example that I just given, you can't make it work selling on Amazon. So, as I say, that's the first example there. Sorry.
Can I just ask you
Yeah.
just a couple of quick questions on that? So
Yeah.
you've obviously spoken about margins.
Yeah.
Obviously, you and I are familiar with that. I'm assuming you're talking gross margin rather than net margin, where you're kind of looking at this. So that's your, your gross profit divided by your sales to get that. How would you define low margin versus high margin? So, are we talking less than 10% is low margin, less than 5%? What would you describe as low margin?
It does depend on product, but I think 20% might be the barrier.
Okay.
As I say, you can have items at 15% that will work on Amazon. You could have items at 25% margin that may not. So there are other factors, because when I'm just giving that one example there, that's a 5 kilogram bar. Now, if you're selling very small items on Amazon, you can get away with smaller margins because the packaging and posting costs could be less and the storage costs could be less. So a 5 kilogram bar is going to cost you more to ship. If you've got 100 gram, I don't know, sea salts or something like that, you could get away with smaller margins there. So you've got to be careful there.
And this kind of then ties into making sure that you have a really good financial model that actually takes into account all of those costs depending on the type of product you're selling, doesn't it? Because you can't just sort of rule of thumb it without going through the...
Absolutely. And it's good that you said financial model, because the other thing with Amazon, so when you're looking at, go back to the 1P, which is the wholesale to Amazon, and 3B is using it as a marketplace. Now, if you sell 1P through Amazon, you've got 65-day payment terms from when you deliver to Amazon. So when you say business model, what you've got to look is the cash flow model on this as well. So I'm just going to give you another example. I do a lot of examples here because sometimes it's the best way to explain it.
No, it's good.
A lot of companies, in fact, the majority, have their items manufactured in China. And with China, especially being a small, medium, maybe not so much a large company, Chinese manufacturers want cash up front. So let's just say you've got £100,000 worth of stock that you can sell for £200,000. Great margin, 50%, absolutely fantastic. However, that £100,000 you might have to spend on the 1st of January to start manufacturing in the middle of January, to start actually getting the goods made by the middle of February. Most shipping from China to UK is about 2 months. So middle of February gets you to the middle of April. Then Amazon might not put their order until, let's say, the 1st of May. And then you've got 65 days to get paid. So you're not actually going to get paid until July. So this is the other thing that you've got to really understand about e-commerce, is that you may have the model, you may have the margin, but you need the cash flow or you need the financing. So as I say, it really is, and I'm going to sound very biased here, but the FD in an e-commerce business is the most important part, as well as the purchasing manager, because between the two, there's so much interaction. In the same way that what I spend a lot of my time doing is speaking to the purchasing manager that doesn't want to stock out and doesn't want to be in a situation where he needs stock quickly. But I need that cash to the least amount of cash possible to be tied up in stock. So we have meetings time and time again, just to say, look, you've got too much stock, and from his point of view, we've got too little stock. So that it's not so much a personality clash, but a professional clash between what is the right level. And the managing director in most e-commerce business is the one in the middle that has to decide who's right and wrong, apart from when the finance director says that won't work. It gives you some of the dynamics of how an FD in an e-commerce business works.
It might be a good time now actually to share. You did that sort of simplistic view of the stock management thing. Let me just quickly bring that up a second. So just for any FDs watching, this is designed to be very simplistic so that it's accessible to anyone that doesn't understand numbers particularly well. So Michael has an incredibly comprehensive spreadsheet that he uses on his clients, but obviously he can't share that with us because of confidential data. So he's reproduced something very simplistic just to talk through the principles. So Michael, if you want to sort of go ahead and sort of chat through, and I'll point at the relevant bits.
Yeah, so this leads on exactly what I said before between me and the purchasing manager. So this is a minimum stock level report. And what you do for every SKU, so when we talk about products, when it comes to e-commerce, we call them SKUs. And normally I'd have several hundred or several thousand SKUs. So this is a very long Excel spreadsheet. And what you've got here is just basically the SKU number, description of what it is, the current stock level at that moment in time, the price and the stock value. So it shows you how much cash is tied up in stock. The next column is the 30-day stock level, sales level. So this shows you how many of those units, so we'll just do it in units because it's the way that you would produce this report, have been sold in the last 30 days. And the multiplier just basically multiplies the stock level divided by the sales units.
Yeah.
Now,
so that divided by that.
Yeah. So what I've done here for product one, I've also got next to it the pre-order level. Normally you wouldn't see it on this report. And the reason why is that this is a very simplistic report. We have algorithms because a lot of products that you sell, as I said, I was in a Christmas decoration business, is seasonal. So you know the sales in the Christmas decoration business in April is not going to be very high, yet in October, November, it's going to go through the roof. So you can't just look on the last 30 days sales. We put that in there, but we also look at this multiplier, and in that multiplier, it sounds again very simplistic, but when you've got 2,000 lines, remember seeing green, red, or in this case yellow, really helps you very quickly identify what the problem areas are. So if we just look at the top line here, we've got 100,000 units of this stock, and we've only sold 15,000 units in the last 30 days, and it only takes us 2 weeks to replenish. So the obvious question here is that why have we got so much stock?
And so, you were saying before we started this webinar, when we had a chat previously, that you would ideally expect that between 1.5 and what was it? 3. 1.5 and 3. And so the fact that it's 6.67 means that you've got a lot more stock than you want to have, given that you can actually order, get stuff in within 2 weeks. That's correct, isn't it? Whereas moving down to this one, which is almost identical bar the price, this one is also 6.67. So the reason why that is green is because you need to have more stock of it, because you've got a 4-month lag time basically to get the stock in. And then on your fancy spreadsheet, you've got an algorithm that sort of calculates whether it's red or green, basically based on the pre-order value, doesn't it?
Yeah, absolutely. You explained it very well. Better than I could, actually, Kate. E-commerce finance director soon.
Maybe I should go into teaching. My mum's a teacher. So no, it's only because we had to chat about it, and I was kind of like, okay, that does make total sense. And then so the reason why, so this second one is obviously between the 1.5 and the 3, so you're happy with that. Whereas this one is 1.33, so you're saying actually that is potentially low because you've only got 100, but you've actually sold 75 in the last 30 days, and it's going to take you 2 months to get it in. So actually that's a warning thing to say it's too low potentially on that one, and that you need to order some more.
So that is, it also brings me on to another point. As I say, e-commerce can go in many different directions. So let's just say that you've got good margins and you've done the financial model, the cash flow works. If you're selling through Amazon and you could easily sell 200 SKUs through Amazon as a business. If one of your products stocks out, you basically get a black mark against your name. And that could mean, and is likely to mean, that all 200 of your products gets listed lower when someone searches for them on Amazon, which does affect your sales. So the other point of this is you can't stock out. So this is the point at which it's very difficult, and you've really got to understand the operational part. And you've also got to be very careful that when you're taking on these products that take 4 months, you may well, this is why when you look at the bottom, you've got 6.67 times the stock. You've got to be very careful. So for example, where we've got that 1.33, where it's 2 months, you can, especially with Amazon, you can, let's say, stop the marketing, or you can stop selling multi-packs. There's lots that you can do to slow down the rate of sales, because it sounds very weird, but the worst thing that can happen for an e-commerce business is for your product to fly off the shelves.
Yeah.
Because what will happen in that situation is that you cannot stock that product. There will be somewhere else in the world that will be able to stock that product. And then they'll go onto Amazon, they'll replace your position as number one, and they'll take that over. So it's a very weird situation whereby you want good, growth of sales, but you don't want very good growth of sales, because that can actually cause you a lot more problems than you actually get benefits from.
But that's like the principles of growing a business anyway, isn't it? Because if you grow too quickly, your operations, your fundamentals of your business aren't going to keep up with it. We often see finance teams not able to cope because they haven't got the right housekeeping in place as those businesses scale, if they scale too quickly. And also, going back to your working capital requirements, if you scale too quickly, you potentially are going to eat into your cash and then run out of money, even if you are profitable. So there's a lot to be said for not growing too fast.
Yeah, but this is more detrimental, because if you grow too fast, not only will someone take over that, all your other SKUs that you sell, all the other products that you sell
get
will
demoted.
also be detrimentally affected. So again, it's a really hard mix, and this is why, as I say, the purchasing manager, the purchasing director, and the FD talk so much, and we communicate so much, and then we ask about products so much. And where we've got a 4-month lead time, that's based on shipping. You can actually air freight items in, and it is, don't get me wrong, I have air freighted items in on a fairly regular basis just to make sure we don't stock out. Because even though we will lose money on that, it's more important not to stock out than it is losing money.
Because of how it impacts everything else. Yeah. That's really interesting. It's really interesting. So have you learned the hard way then with Amazon? Because it sounds like Amazon, your experience with Amazon has been very much in the last sort of few years, as opposed to like previously it sounded like it was more sort of through companies' own websites and stuff. So have you learned the hard way?
Yeah, I've certainly learned the hard way, and I think it was the teddy bear business that I mentioned earlier, the £1 million teddy bear business, because with Amazon there, we did a lot wrong, because we was a very small business, and that was only a very small part of a bigger group that was turning over 20 million. So we just sold teddy bears. It was a children's entertainment group. We had our own play centers, etc., etc. And that was a very small part. And what I learned on that there, and again, it goes back to margin, is that we found out that we were selling bears for £14 in our shops, and we could import them for £3 from China. So we're thinking, well, wait a second here. Why are we paying someone else to do it? We'll just do it ourselves. Easy enough. We found out for each bear, it only costs about £3,000 to go through all the testing that you needed to be regulated to sell. So it all sounded absolutely fine. And then we found out that to sell the bears through our own website, we were getting 2 sales a day, which just didn't cover the costs.
Oh, wow.
So, and when we say 2 sales a day, if we're selling for £14, if you knock off very roughly £3 for VAT, £11, then you're knocking off the shipping, which is another £5, and it's costing you £3. You're only making £3, so you're making £6 a day. It wasn't great. However, what we realized is that if we sold through Amazon, we would get an extra 80 sales a day. So that was great. It was like, savior. Apart from when we found out that in that example, you've also got to take off the Amazon fees, we were making virtually nothing to start off with. In fact, we was losing a little bit of money. And what we also learned with Amazon, they're very difficult to deal with. Very difficult to deal with. So I think a lot of people got Amazon parcels whereby they order, let's just say, a key ring, and it comes in a massive box. And you think, well, that's Amazon, they're so inefficient. But when you realize all of the requirements that you need to fulfill for Amazon, you get to a stage where some people, especially if they don't understand Amazon, will just put in a big massive box because they tried the small box, they tried the medium box, and they just want to get the actual order out. So actually meeting the requirements of Amazon is extremely difficult because you need to know the box sizes, you need to know whether it's temperature, you need to understand where on the packaging you need a label for Amazon to scan it. There's all these technical parts, in fact, far more than I know. I've learnt it quite a few years ago. I've forgotten half of it, and I'll put my hands up to that because I'm more at the FD side. But what I fully understand, and going on from my pharmaceutical company that I'm an FD with, we actually buy products from Unilever, and we're sort of the middleman in the middle, where we buy them direct from Unilever and then we sell them from Amazon. Unilever could do that themselves, but Unilever have got to comply with Amazon, and Amazon's also changing all the time. So it's not like, right, you get this right, that's it, it's done for a lifetime. The latest thing is with Amazon is that they require in America, and America's always the starting place. So if you're looking to sell on Amazon, look at what America's doing to start off with. So in America, you need at least 30 days worth of stock or you get fined. So
Oh,
so this also affects cash flow because where I showed you the example before that you might be able to get stock within a week, you're thinking, well, if I get stock within a week, I don't want 30 days worth of stock.
no, no.
Whereas now within Amazon, if you sell directly to Amazon and you explain to Amazon, we can get the stock within a week. So 2 weeks lead time, we can get you as many stock as you want. Now you've got to have more stock within Amazon. And
Okay.
that will come to the UK at some point. So again, it really is very tricky and difficult to work with, and it's always changing. So
Interesting.
so yeah, it is hard, but there's also a flip side to this. So if you're a new business and you're thinking, my margins work on Amazon, what you can do is you can just go to an Amazon fulfillment center and they deal with a lot of it.
Okay.
So, and this is the great thing about e-commerce. So forget about Amazon, which we spoke about a lot, and I'll put to one side in a minute.
Yeah.
With e-commerce, you can basically sublet or subcontract out every single operation. So,
Mm.
if me and you today said, right, we want to sell soap bars, we can get a marketing agency to design all the marketing that you need with all the posts that you need. We can get another company to design the soap bars. We can get China to manufacture it. We can get a freight forwarding company to do all of the logistics with freight, and we can get someone that's at an Amazon prep center in the UK to distribute in the UK. We
Mm.
literally don't need to do anything. And there's every single part of that operation that you can sub out to someone else. So especially when you're starting out, it's not a bad idea to do it. Just for the simple fact is that there's so much to learn.
Yeah.
Um, so that's the flip side from what everyone's saying. And the better you get at it, the more that you actually get in-house, because obviously you don't want anyone else having a cut and you want to have the control. So obviously it's the same with subletting anything. You know they're
Yeah.
going to make a bit of profit and you know you're going to lose control.
Yeah.
So it just depends what you want to do.
Yeah. No, that was the point I was going to make. It's all very well like subletting all of this stuff, but or outsourcing it. But if you haven't got sort of a high margin business, then you're not gonna it's not gonna work, is it?
Yeah. Actually, there's one other point that I wanted to say because obviously a lot of our FDs are looking at this as well. With Amazon, there's also companies out there called Amazon aggregators. What
Hmm.
Amazon aggregators do is they actually buy businesses that sell, it's normally a very flat £1 million or more per year or $1 million per year on Amazon. And the
Yeah.
reason that I say this is that I haven't done it myself, but I know a couple of other people that have, whereby they've got a big portfolio and you've got an owner and they obviously most owners do not want to sell their business, but they want more cash and they want to sort of just the ideal situation is selling part of the business. Amazon aggregators get this, and if you've got a product range or a product that sells $1 million outside in the US or £1 million in the UK on Amazon and specifically on Amazon, they will normally buy that for 5 times EBITDA. So you can hive off part of your business, and especially with Entrepreneurs Relief at 10% at the moment, You can sort of like go to the owner and say, look, if you want to hive off this part of the business and we sell this, you know, there's people there that can actually buy it if you sell it for Amazon. And you've also got to consider this, because if you're in the boardroom and you're looking at the structures of the business, one thing to consider is that if you want to get, let's just say, we've got this business, it's selling £1 million a year, the EBITDA's £200,000 a year, so you can sell it for £1 million. If you structure that business so that that entire operation is in with that one company, it's very easy to sell, then you can hive that off and sell it, and then you've got this £1 million coming in, which as an e-commerce business is absolutely fantastic, because with that £1 million, you can then buy more stock over here, what you're really interested in. So it might even be the case that you're primarily looking at, I'll go back to soap bars, and that's your business and you love soap and that's what you want to do, but you've got some shower gel over here and it sells and there's £1 million, but you're not interested in shower gel. If you can get that up to £1 million and sell it to Amazon aggregator, you can get that £1 million back into the business. And it could be the owner just wants to have a bigger house or this, that, and the other, but you can actually use that cash to filter back into the business. And again, I think one of the points that you wanted me to go through is that what we can discuss in the boardroom, that is something that you can consider with the group structure of the company and how you actually lay it all out.
Okay, so just to clarify that then, so if you've got an e-commerce sort of line within your business that is maybe not your passion, but is doing well, then there are businesses out there. So you're calling them Amazon aggregators, but effectively they're equivalent of private equity businesses that buy up businesses, combine them, and then on sell. So there are businesses out there that would buy that section of your business. So your example that you're saying, the shower gel bit of the business that you're selling online. And you should get a multiple of 5 times EBITDA, which if you've got 20% invariably is your revenue for that bit of the business. Is it like private equity in that the bigger your turnover and EBITDA is, the bigger the multiple is? Does it work in the same way? And is there kind of a minimum that these aggregators are looking at? So if you only sold 200k, would they still be interested? Are they looking for a minimum of like a minimum turnover, minimum of a million, let's say? Sorry.
So to answer your first question, yes. I mean, I'm very generic in a lot of what I say. So there could be a case where instead of £1 million turnover, it could be 10 million turnover, and they might give you 6 times EBITDA because they just like the product. So it is slightly different from private equity, as in these businesses are very good at selling on Amazon, and they look at something and they can just see that, wait a second, it's not doing too well. And these businesses, they might take something that's selling, let's say in this case, £10 million in the UK, and thinking, well, wait a second, that will sell really well in the US. And we've got a whole office in the US, and that will sell really well in Brazil. So they'll take that 10 million and they'll probably just keep the business, but instead of selling it just in the UK, they'll sell it in Brazil and America and put it all over the world. And they'll know what they can and cannot do with it. To sort of like the latter part of the question, there is a very strict line when it comes to turnover. And it seems almost stupid to a certain extent, where I said the $1 million and £1 million. So if you had a business that's selling, let's say, $800,000 on Amazon and £100 million in the stores, and then you had another business that was selling $1 million on Amazon and £1 in the stores, the Amazon aggregators would only consider the business with £1 million sales on Amazon and £1 in the stores. They wouldn't consider the other business.
Can I just clarify that you switched between dollars and pounds a fair bit? So did you mean £1 million for the minimum on the Amazon business? Is that what you meant? Yeah. Okay.
I think in the UK it's pounds, in America it seems to be dollars.
Okay. So depending on where you're based, but but we're looking at roughly £1 million or dollars, depending on where you are. Obviously, slightly lower if you're in the US. Okay, that makes sense. And the next question that I'm sure people are thinking, that I'm definitely thinking, is I've got this e-commerce business that I now want to flog. How do I find these Amazon aggregators? Is it as simple as putting it to ChatGPT and saying, give me a list, or How is that simple?
Yeah.
Okay.
So Amazon at its heart, and I will get off of Amazon a little bit,
Yeah,
because
we've got
I
other
can
questions
see,
to go through.
yeah, there's other parts to it as well. So Amazon at its heart is a data company. And the reason why they're so easy to sell these businesses is that because you sell for Amazon, all the data's there. So it's extremely easy to audit. The due diligence is phenomenally easy. It's one of the safest businesses to buy. So because they can just go into Amazon, they look for all the data, they can see it all checks out, and when I say they give you a check within a week, that might be a bit extreme, but you get the idea. It's very easy for them to purchase the business.
Okay.
But should we move away from Amazon now?
Yeah,
Because I've talked
let's
about it
move
far
away.
too much.
You were going to tell me about the big things that are happening in e-commerce at the moment,
Okay,
apart from Amazon and Amazon aggregators that I was completely clueless about before this webinar.
Sure. Okay, so the big thing now is TikTok Shop. So we have
Don't
so
say that when you're
TikTok,
drunk.
yeah, exactly. So with TikTok, which most people know, what they've done, which is a very good idea, is they've added a shop. So if we say we're looking for, let's just say lipstick, MAC lipstick. Now the way it all goes from the customer journey, the whole of the internet should be about the customer journey. Not everyone understands that, but it should be about the customer journey. So if you got MAC lipstick, you may well go on mac.com to buy that lipstick. You might put it into Google, you might go into Amazon, which I'm trying not to mention. That's absolutely fine. If you just want lipstick, you don't know which one you want, you might again go to Amazon. Probably not. You probably go to a Superdrug or something like that, a generic store, something like that. You might put into Amazon search. Now, what TikTok does is it comes from a completely different angle. There's lots of people that go onto TikTok and they look at videos, they look at this, that, and the other, and there might be a TikTok where someone's put some lipstick on. It looks really great. The reviews are very good. Reviews, when it comes to any product that you sell online, is very, very important. I'd also add in here at that point. So you've got someone, you've seen them on TikTok, you did look at this, and it's not a very expensive item. And what TikTok Shop do is you've got the opportunity to basically buy that item then and there. And when you actually look at the sales figures, TikTok Shop has got nowhere near the sales figures of Amazon as you expect. In fact, it is quite small. But what TikTok Shop is very, very good at is getting new customers. So to give you an idea, we deal with lots of multinationals in that, and we speak to the marketing departments, and I can't say which ones, but there are marketing departments out there that will spend £40 in advertising revenue to acquire a single sale for an item that might only cost £30. And the reason why is they want the new customer. And because they understand that, yes, on that first deal, they'll lose £10. But if that customer really likes that lipstick and then buys it another 100 times, then the lifetime value justifies paying so much for that initial lipstick. So what you're getting now is you're getting more and more companies using TikTok to sell. And with TikTok, and I hate to say this again, is that what they've done is they've looked at Amazon because it's got a huge distribution, it's got a huge warehouse, and they've sort of, in the nicest possible way, just copied the entire lot. It's literally because Amazon are so good at it, so why try and do it better? They've hired a lot of people from Amazon to understand the fulfillment. So when you deal with TikTok, you've got fulfilled by TikTok, which is also very similar to fulfilled by Amazon. And when you look at the back end of it, it's virtually the same as dealing with Amazon. And it also helps because if you've got a department, an e-commerce department within a business, and they've got a flip between Amazon and TikTok, it's very easy to do. If you know how to use Amazon, you pretty much know how to use TikTok. So again, if someone's thinking of sort of starting up an e-commerce or has a business and wants to go into e-commerce, and they're thinking, sure, do Amazon, sure, do TikTok, in the nicest possible way, you might as well do both because in the back end, it's not very different at all.
How do the costs compare, though?
At the moment, TikTok is cheaper. So TikTok is being subsidized by the Chinese at the moment. It's like anything. When you start out, and TikTok Shop is starting out, they want everyone to use it as much as possible. They want sort of like business like us to use it. So if you look at sort of like the distribution of some parcels, we've been charged as little as 50p to parcel items out. You know, Amazon, you know, they'll just laugh if you said, "Can you do it for 50p?" So it really is a lot cheaper at the moment. We know it's going to go up, but the whole idea is that, and this isn't any conspiracy theory, it's just plain fact, is that the Chinese government are putting lots of money into TikTok and into TikTok Shop to get up and running so that it can be, you know, a competitor to Amazon in probably about 20 years' time. But it's what's happening at the moment. That's why it's so cheap.
Interesting. You've mentioned right at the start of the webinar about selling through your own website. You've spoken a lot about Amazon. You've spoken a bit about TikTok. How does selling through your own website compare with using those two channels?
Okay, it's very difficult. The simple fact is that if you've got a product that everyone knows about, brilliant. So again, going back to that MAC lipstick example, people, you know, especially the female half in the nicest possible way, they understand about MAC lipstick, they understand MAC, they've heard about it, they'll go onto that website, it's very well known. Now, going back to this soap example that we said earlier on, if we did that and we set up our own website, no one's going to go to it. There's just no one's going to go to it. So if you've got a product that's very well known, it works. If you haven't, it's a very long, hard slog. For the simple fact is that if you're looking for, let's say, soap, I'll keep and go back to soap bars because it gives you the same example. I've got, you know, no interest in soap whatsoever, apart from using it to wash. But the simple fact is that if you put soap bars into Google, there'll be probably 100, if not 1,000 companies that will come up before our website that we've created. So therefore, you need to do what they call pay-per-click to get you advertised, to get up to the listings, which in itself can cost quite a lot of money. You'll be competing against Unilever, which makes soap, and their budget is vastly more than you can possibly imagine. You'd never be able to compete with it. If you want to sort of try and have influencers, again, it's very different. So I've used influencers many times to promote many different products, not just e-commerce. One thing that if you're starting out and you're thinking going to e-commerce, what a lot of people do is they think, all right, we've got all these products, let's give them to influencers. If they use them, great. Always pay an influencer. The reason why I've and you said, you know, have I learned the hard way? Yes. So one of the products that we gave to an influencer, and I'm not going to say the company, we gave them a really good product. We just wanted to get this influencer to do it, and we are just thinking, oh, it's a bit cheeky as such, but you know, have the influencer. Yeah, they did show the product, but they also showed a competitor's products for which they were paid for, and all the actual like post was or the video was about how much better our competitors' products was to us. So yeah, as I say, you've learned the hard way, but when I say influencers, you've got to pay them. And the one thing that I would certainly suggest you don't do is just give out free gifts to influencers, unless you've got some sort of contracts whereby, I mean, if it's, let's say, photographic equipment worth a good few £100, and you say, look, in return for giving this, you've got to give at least a positive review, fair enough. Randomly giving gifts to influencers it can really backfire on you, really backfire on you.
Yeah, maybe that's why I'm not in the e-commerce business. I don't think I particularly like the whole giving anything to influencers to promote my products, because it just doesn't seem particularly genuine. So yeah, it's tricky, isn't it? Facebook marketing, we haven't spoken about that. Where does that sort of lie in all of this?
Okay, Facebook marketing was very good about 6-7 years ago, and you got a good return because, well, when it comes to spending money online, you've got what we call cost per acquisition of sort of like customer. And the great thing about e-commerce is that the data is brilliant. So if you're spending $100 or £100, sorry, I use dollars so much, it's just what I'm used to. If I'm using, let's say, £100, I'll be English here.
Yeah, be English. We're in England.
Yeah, absolutely. Then what you actually know through all the tracking, how much return you get for that £100 that you spend on, let's say, Facebook. And I've looked at these statistics now for year after year after year. And with Facebook in particular, the returns have diminished quite a bit. to such an extent that it's really become in non-core for us, whether we advertise on Facebook. The best way to advertise for me and for what I've seen is still Google pay per click, and that's
Yeah.
whereby you pay to get your listing higher on the Google search. So yeah, so that's Facebook in a nutshell. Sorry, Facebook, about that.
No, it's good. And just on that, you're saying like the return on investment is diminishing. What was a good return on investment, and what has it gone down to now? Just to give people some context in terms of what, if they did that calculation, get the old calculator out, what would that be looking like?
I mean, it depends on the business, but if you're going back about 6 years ago, for every £100 that you spend, you would probably get £1,000 back. So it was like,
Okay.
well, this is great. And the other thing that I would also say is that when you spend with Facebook, the more you spend, it's not just Facebook, it's all of them, whether it's Google pay per click, the more you spend, the less you get back. So if you spend, let's say, £100, you might get £1,000 back. If you spent £1,000, you might only get £5,000 back. If you spent £10,000, you might only get 20,000 back. So you need to find the right margin. And what I'm also saying is that the amount that you're getting back is revenue. So you've got to look at the gross profit as well. So when we're looking at that, so for what we got 6 or 7 years ago, where if you spend £100, you get £1,000 back with Facebook. Now, if you spend £100, you probably get £500 back.
Okay.
And the problem with that is that you're thinking it's 5 times what you spent. Great. But you've got to look at margin. It's always the margin that you're looking at. So let's just say that you've got a 20% margin on that £500. So you're spending £100 on Facebook to get £100 of gross profit.
Yeah.
It's a nil return.
Yeah.
Whereas if you went back and you spent £100 on Facebook 6 or 7 years ago to get £200 worth of profit, fantastic. So again, you've really got to look at the actual gross profit and sometimes also the lifetime value as well. But as I say, Facebook at the moment is something that we're not concentrating hard on.
Okay, that's interesting. Now, in terms of, we've spoken a lot about sort of maximizing revenue and sort of opportunities there. What about sort of looking at cost savings for e-commerce businesses?
Okay, so with this, for my sins, I was an auditor when I was younger, and which is
So was
actually
I. So was I.
yeah, I think we all say that there. Now, like lots of people, you probably went to a business with a warehouse and you looked
Did
at the
the stock
stock.
take? Yeah, stock
Yeah,
take on a
yeah,
Saturday. Yeah.
yeah, absolutely. And it was there. You had the pen and paper, and it was like, yeah, it was in the nicest possible way. It was a bit boring. The last company, it's not e-commerce, they're just doing wholesaling, and I'm working for them at the moment. They are using drones to do stock take. It is something like a Terminator 2, if you've ever seen the film.
I love
You know,
Terminator. Yeah.
yeah, and you've literally the amount of technology that is being used is stupid.
Wow.
It's really interesting. You've also got a lot of time and motion studies. So eBuyer, that was up in Yorkshire that we bought. There's so much in terms of time and motion, and when you look at how to utilize staff, you want them to move as little as possible. So when you're talking about cost savings, a lot of what we're doing in cost savings is introducing technology because you're thinking drones to do technology. Drones don't cost that much.
No.
If you can get the software and you can get the staffing out of it and you get more accurate, a lot of these drones, you can't use it for 100% of the stock, but they can do 95% of the stock and you get one other person. So
Wow.
that's the cost saving there. With the time and motion, if you can get one person to move, let's just say, from, let's say, 3 meters to 2 meters to get parcels, which seems ridiculously,
Small.
pathetic that it's
Yeah.
just like you just like that could mean that person's productivity goes up 50% of the day. And
Interesting.
it's time
Yeah.
and motion. Um, yeah, there's also lots of other things like the packaging you use. So I hate to say this because it doesn't sound environmentally friendly, but the reason why a lot of our packaging is plastic is that we went through a phase where someone that was working with, they wanted a bespoke cardboard packaging, eco-friendly, which was very much in keeping with the brand. So we got that. It cost 50p a unit. Plastic cost 4p a unit. And we were selling 10,000 units a week.
Yeah.
Now, to start off with, they were saying, "Yep, no, this is what we want to do. This is what we want to do." Then their FD got involved, and it was just like, "You do know how much this is costing. We just want to make sure that you're aware of it." And he was like, "What?" He just didn't understand. So, as I say, we deal with other companies and we sell their products on their behalf sometimes, and it's you've really got to understand the cost, because those literally half a p per unit, it makes such a big difference to your product, because you're selling tens of thousands, hundreds of thousands, even millions of these products every single year, and that half a p, it makes all the difference. So
yeah, interesting. Conscious of time, so wrapping up, what would you say is your biggest tip for a UK company looking to expand potentially overseas?
For me, go with Amazon. Even if you're losing money, the best way to expand overseas is via Amazon. It's very simple. I mean, I've worked everywhere from Canada to America, Australia, Middle East, Asia, pretty much every single first world country in the world. We've done something in Australia, Asia, we've done something in the whole thing. And it's so much easier with Amazon, because when you're dealing with these other countries, you've got all of the different rules. So we do VAT returns for Canada, we do VAT returns for Ireland, Poland, and this, that, and the other. And we need a specialist in those countries, because for all the will in the world, I'm never going to be able to learn the VAT rates and regulations for all these countries. Um, Someone like Amazon, and I know I shouldn't keep going about this, they've got special tax deals with virtually every single country. So if you just sell it out there, all Amazon do, instead of you filling out a tax return, they deduct the amount of tax that you should be deducted, and you just get the proceeds. So that's much
Right, so
simpler.
it's so simple, yeah, and you're saving money on professional fees as well, because you're not then having to get a professional to help you.
Fully legally compliant, so you don't have to worry about that. Amazon is known. I mean, to be fair, Amazon's still got a long way to grow. There's lots of countries where it really hasn't grown, but it's known in all these countries, and people will sell on it. If we wanted to, let's just go to Saudi Arabia and set up a new company. One, I think it costs about $10,000 to set up a company in Saudi Arabia. Secondly, you need a sponsor there as well. Then you've got to set up your website. Then you've got a presence on the ground. You just sell it for Amazon, and then you can just sell the product, see how it goes, see if there's demand there, build up the demand, and then you've got the data as well, because as I said right from the start, Amazon is a data company, so that you can see whether male people or female people, people that are old, young, they're the ones buying your product, whether actually there's a competitive product that's actually outselling you. There's so much information you can get, so that yes, if you go and sell, again, soap bars, we'll go back to that, yeah, in Saudi Arabia, you may well lose money, but the amount of data that you get, and the information that you get from something that way, is sort of like the stepping stone to actually go into those countries.
Okay, no, that's brilliant. Thank you. Well, as I always say at the end of these webinars, if you do have any questions, the way LinkedIn Live works, that we can't sort of answer as we go along, but if you do have any questions, put them in the chat, and then we can answer them as soon as we get off. Thank you so much, Michael. That's very enlightening. I didn't know there was so much to e-commerce. Very good. You. Thank you, and hopefully people that are thinking about going into e-commerce, hopefully that was useful as well. So as I said, you know where to find us. You are on LinkedIn watching this, so please do get in contact if you want to know anything further. Thank you so much for your time, and we'll catch up soon. Thank you. Take care. Bye.